Hitting record. Awesome. Welcome, everyone. Thank you so much for joining us today. We are going to be chatting all things angel investing and angel syndicates. You should all be on mute, but if for whatever reason you come off mute, please go back on mute so that we can hear everything that these two awesome speakers have to say today. So hi, everyone. My name is Cheryl Mack. I am the CEO and founder of Aussie Angels. We run a platform that supports people to run their own angel syndicates. And that's why we're here today to talk to Mike and Remco about their new syndicate, Standard Ledger's Ventures. So our agenda today, really, I'm going to I've got some questions for the two of them, and we'll go through a couple of things around investing, what their thesis is, and we will also have some time at the end for all of your questions. You have two options. You can pop them into the chat and I'll read them off to the two of them, or if you want to ask a question yourself, feel free to just put your hand up and I will unmute you. So today we have Remco and Michael. They are the founders and partners at Standard Ledger, and we are going to be talking about Standard Ledger Ventures. Very creative name. We'll not be able to forget it. So I guess we'll kind of jump in, but actually I went to a little bit story. So I met Mike first between the two of them. I met Mike first when I was working at Stone and Chalk. I was national head of community, and I just thought that, he was another startup founder around the place. And I kept seeing him meeting with all these different founders and just sitting there shooting the shit. And I was like, this guy doesn't seem like he's getting any work done. He's just meeting with founders all the time. Like, this founder's not going anywhere. And then I met him and I was like, oh, he's the one that helps founders. That makes sense. That's why he's always meeting with founders. So yeah, we got to know each other. And Remco, I think you and I met a little bit later, but really, really great. I'm glad to have met the two of you, and excited. So let's jump into it. I've talked enough. Maybe Michael, do you want to start just telling us a little bit about your background?
Yeah, sure. I've got a 20-year probably plus experience now. Previously working at Goldman Sachs in the investment banking area as well, and at PricewaterhouseCoopers prior to coming on board at Standard Ledger. We've got 8 years now, running at 8 years, I think, Remco, at Standard Ledger. All things sort of startup, client focused. So I started with pretty much ASX type listed companies when I was at PricewaterhouseCoopers, and then more so at Goldman Sachs. Learned very much entrepreneurial type thinking and having skin in the game when I was at Goldman Sachs for 5 years, working in Melbourne, Sydney, and Hong Kong. That taught me some lessons about how to run a due diligence process, the sort of rigor around how to actually go through investing. I then did investing for myself at the time, and have become very much involved in investing into ASX listed companies as well as the S&P 500 and other companies, and got to understand the likes of Warren Buffett and how he invests, and other investors like Lilu and so forth, and had a strong understanding of how in traditional markets how you invest, and then see how you reflect that in the startup world. So that kind of is quite different, and so that's a bit about my background.
Remco, you're up.
Hey, hi everyone. Nice to see a few familiar faces too. Share a cup of tea together while we talk about this. So I do have a fireside literally in the other room as I'm working from home, which is nice, but it's not in this room with me. My background. So I've been working, also originally from a PwC background as well, coincidentally, but working with startups for about 20 years from the dot-com ages. Adelaide originally, working in a government-backed VC firm at that stage, so investing into startups. Then we had, I call it the 10-year gap, the 10-year death in Australia of the startup scene, and but for the last 10 years, it's been booming. As super funds have got back into allocation of money into there, and increasingly over the last 10 years, as you've had entrepreneurs become successful and reinvest as angels, as all of you primarily are coming in as. So the little tech blip that we've got now. You know, I've been around long enough. Some of you look like you have as well. So, you know, .com, GFC, you know, tech valuations going down now. But fundamentally, you know, still believing in the premise, not drinking my own Kool-Aid, but fundamentally believing in the premise of technology as an enabler, as a productivity improver. You know, ultimately, it's the tech companies that go up to the top of the markets. And excited to be amongst it, as Mike said. You know, I've been doing Standard Ledger itself for the last 8 years. So, yeah, great to be in the space.
Awesome. And just quickly for context, can you just give a quick explanation of what Standard Ledger is?
Sure. So, Mike, do you want to go first?
So Standard Ledger is a boutique accounting firm that provides tech-enabled accounting tools to startups. Whether we're agnostic about the type of startup, whether it's medtech, fintech, or agri-tech, or any type of tech, and the services we provide are CFO, financial modeling, valuations, etc.
Perfect. And you each done a little bit of angel investing yourselves personally. Why? Like, why did you start?
Yeah, so it's really difficult to get a really good return on investments in the S&P or in the ASX listed companies with small amounts of capital. And I started with the Sydney Angels about 5 years ago, so just want to understand the process of how to invest in a syndicate. And with small amounts like 5 to 10 or 20 grand, there are opportunities there to make, you know, 5x, which you wouldn't otherwise be able to if you were had that small amount of capital and investing into the S&P or the ASX. You might get a decent return, but not sort of a return or transformational type return.
And for me personally, as I said, you know, I've been playing with startups, so my default go-to is invest into startups. I'm not that interested in the stock market, right? For me, that's a bit like just, you know, throwing money over the fence. I'm much more interested in being hands-on. You know, that's the way we run our Standard Ledger core business, but also as an angel investor. So I'd much rather build businesses, and that's hopefully, I think, a shared motivation of plenty of the angel investors.
Yeah, for sure. I'm with you. Don't have too much on the stock market because it's just so I guess, like, you know, we've had a pretty crazy last couple of years, as you said. But what about the next 12 months? Like, Mike, what are you excited about?
Well, Standard Ledger ourselves, we've just expanded to the UK. So we've got exposure now to UK startup clients as well as Australian startup clients. So being over there a couple of times in the past year or so, there's a lot of sophisticated startups there in different spaces that we're now providing, you know, CFO services, financial modeling, valuation services. It's interesting to see that, you know, we're growing in that space and that there's a strong, sophisticated market out there as well as in Australia. We're probably in the kind of, everyone's aware of sort of the macro area and the problems, but I'm excited that we're growing into a new geography in the European sector, and that's what gets me going at the moment.
What about you, Remco?
Yeah, and it's interesting, just a little internal hurdle that Mike and I use even when we're looking at deal flow, right? Because for us, as I'm sure it is in each one of your businesses, there's a conscious choice to be made. Do I invest, let's call it spare capital, right, into my own business, right? And our own business is growing really well, right? So, you know, part of our internal hurdle is almost like, well, why would we invest into these other startups, you know, with our own money, right, versus investing into our own business? So conscious choice, right, as we're investing. So that's an unofficial little hurdle. Now, hopefully, like most of you, we're not afraid to take a punt at some early stages, right? That might be a little riskier. And sorry, just to go back also to the question you asked before, Cheryl, that over the last couple of years, both individually and collectively, Mike and I have dabbled a little, right? And again, that's probably, and you can probably talk more to this, Cheryl, than we can, that that's the road that many angels come to, right? They dabble a bit. It's a bit ad hoc. You know, we look each other in the eye. Does this one look like a good one? Sure. Right. And so over the last couple of years, anything, it's been a bit random. And usually the founders, it's often the founders, as I think most people would relate to, that we've come across that are doing interesting things. So cancer diagnostic one, who wouldn't want to have a cure for cancer kind of in the portfolio if it comes off, right? Long shot, right? Again, know the scientist behind that really well. DNA analysis, cool. Still working on the science, right? That's a longer term play. In my darker times, I had a little crypto play there as well, but a bit jaded about that, to be honest now. So you won't see any of that from me. But in some of the more brand names that some of you might recognise, Mike and I were early investors in Cake Equity, and most of them, Cake Equities, I'm sure, hit everyone up here to manage their shareholder interactions, right, and their ESOPs and stuff like that. We do a bunch of vows around their ESOPs as well. Cake Equity, and then I've always wanted to be the bank, right? If you can, be the bank, and this is hopefully what we can all be together, right? Be the bank and invest into things, but a little bit of exposure to that. We put some money into Virtual, the platform, right? As well, and with Cheryl's help, in fact, we put a little bit of money into Black Nova. All right, so we're trying to get on the money side as well as on the startup side. So have a bet each way, if you like. So we're now ready to get more sophisticated and more rigorous with our own approach, right? Running the lens over our clients, all right, and bringing the deals through.
Yeah, awesome. And so you guys are what we kind of often call operator angels, because you've got like the specific expertise, right? You've kind of got that financial background and skill set. You look at spreadsheets way more than I could ever want to in my whole life. You probably do that in like one day. So like maybe just talk a little bit about like when you do invest, how are you helpful?
As CFOs to a number of clients that we have day to day, we've been doing this for 8 years. We're fundamentally, from my perspective, about mitigating the risks and removing as many risks as possible for founders, so that they can get to that 5x exit that they're after. And that might be, operational risk and client risk and customer risk. Every day we see a number of risks that we have with clients. So we're ultra cognizant of the issues that they're facing day to day. So we do a lot of financial modeling that ensure that they have cash flow that for the next stage, so they can raise for the next stage, so they can grow. If they're trying to get staff, what do they need? What sort of cash flow do they need? If they're looking at different metrics to face investors, what are the metrics that investors are looking for? So we're doing this day to day as our own CFOs and ensure that our startups don't fail, because cash is so important at the moment. It's nice to say, I'll get 4 or 5x, but if you don't have sufficient cash to actually get there, there's no point. So there's a lot of those type of things that our founders as clients, and we're founders too. We're working this out as we go. We're expanding to the UK. What does that mean for us? So we understand from startups, if they're expanding, they're facing the similar problems for us as operational type investors. We're constantly in what I would say the weeds of the businesses, and therefore we sort of understand what our clients are facing day to day.
Yeah, and that is really the premise of some of you on the call are founders yourselves, so and our clients. But yeah, fundamentally, the premise of the syndicate is that we are inside our clients, so well known to us. So, and what that means is not only do we get to know the founders and the cash position, right? But that we're putting it forward when we genuinely believe there's something that ticks all those boxes, right? I myself, as an operator, just to pick up on that phrase, I sometimes call myself a cash hustler. All right, yeah. So you talk about growth hacking. I'm a cash hacker, all right, from time to time. So sure, look forward, right? See when the cash is going to run out, as somewhere on the time horizon. Most of our startups, it's going to run out, hopefully not as short as 3 months, but 6, 12, 18, 24 months. what are the things we can do to prop that up, right? Equity is part of it, which is kind of cool to bring into the mix, but within our own remit, what can we do to access, the venture debt that's out there more than ever that's coming into the industry? Is it more of a consumer proposition? Great, let's go and talk to the guys at Virtual, right? And spin up a campaign. Well, why are you raising money? Most of that's for R&D. Cool, right? Maybe we don't raise it all through equity. Let's go and get an R&D loan, right? Save the equity for the marketing, etc. So we're very much about, equity is not that, even though we're here to talk about equity today, right? Cash hustler at an operator level. And yes, by the way, all that accounting stuff, right? And yes, I am a CPA, but growing the business and being a hustler is far more interesting.
Yeah, I think that piece is really important. Like a lot of founders think about, I need to raise money, but there's actually lots of different places you can raise money from, and like grants, the R&D, tax back, and other opportunities, and debt as well. Like having somebody in your corner that understands all of the ways that you can bring money into the business to help growth, I think is really important. So I think that's awesome that you guys have that and offer that. Cool. Let's talk a little bit about the syndicate. Like, why did you want to start an angel syndicate?
Yeah, so as founders ourselves, we know what day to day what our current founders face. So as I sort of alluded to before, in terms of all the risks that are associated to, we know what they're facing. We too are facing that as well day to day. We know, being around for 8 years, we know what works and what doesn't work, what's best practice. We see some of our founders, clients have failed and started up, and some of our founders have been highly successful. And so we've seen how they've done it. What best practices are they using? What are they focusing on? So I think because we can bring to bear that sort of personal insight from our clients, we can leverage off that and provide sort of insightful sort of analysis about what would work for a founder to actually make it grow and mitigate mitigate risks. So I think from that perspective, I think we provide that sort of a useful insight that other sort of syndicates might not. Where often I was a founder, they would say, and I know what's working. Well, we are founders. We know what the latest technology is happening. We know what currently, contemporaneously, is what's going on in the market, and what is working. And obviously, we've got sort of clients in our suite at the moment that are hitting 5 to 10x, and we're going, how are they doing it? And we're seeing, they're telling us what they're focusing on. So these sort of useful insights provide us sort of that sort of edge that we think would be valuable to the syndicate.
Actually, maybe on that point, I was just saying, on that point, we have a question that's probably right on there from Ben. Like, is there anything that you've learned through the Standard Ledger business about what well-run startups look like that you can apply to your angel investing through the syndicate?
What we've learned? So being very, very customer focused. Being very, very customer focused on the product and the service, providing consistent product and customer value, it's really ensuring that you don't have as much a really low churn. What does that mean? It means making your business very, very scalable from a customer perspective. So get your processes and systems in place so it can scale effectively. And so we've seen from our different clients that if you focus on that rather than the top line revenue or something like that, it actually ensues the success rather than you focusing on one particular number going out. You focus on customers and consistently providing quality good service.
I'll add to that a little bit. No bullshit, right? We're lucky enough again to work with founders, quite a strong predominance, and it's not surprising in a way, of bootstrap founders originally, right? So they're spending their own money. When you spend your own money, right, you act in a potentially different way than when you spend investors' money. You shouldn't, but right? There is that. And so no bullshit, both to yourself as a founder, right? So yeah, we don't like ego, right? Mike's shaking his head. And so don't fool yourself as a founder, and certainly don't fool others, right? So, pure marketing spin, we're not, sure, as a way of attracting clients, you need sales and marketing activities. But on a premise fundamentally to what Mike said of it's a sound business providing something of value, right? We've got a large contingent of business to business, right? That's fair to say. So while there are some consumer facing product companies that we've got in our client base, and we'll call it our portfolio, largely what am I as a business providing to another business that they value? And just keep doing that and keep doing it well. Look after your customers, look after your people, right? But again, most of your business owners, you're just going to go, of course, we look after our customers. Then look after our people, they look after our customers, and the money kind of should look after itself, right?
Yeah, that's a really great question. Thank you, Ben, and appreciate the insights there. So let's talk a little bit about your investment strategy. What are you looking for in companies? What kinds of companies are you investing in, or going to be with the syndicate?
So I think, as Remco alluded to initially, if you're not, we've got a business that's doing well ourselves, it has to beat that financial hurdle already, which is significant as a metric, as a starting point. We're looking for founders who, as they say, no bullshit, that are driven and focused. Essentially, people say that, but I want to see consistently over time that behavior of I'm driven and focused on providing customer product or service consistently. They've got to meet, a significant financial hurdle year on year for us to sort of deploy capital to something else that we otherwise wouldn't put to ourselves. We're looking, the sort of companies that I'm seeing doing well, I think that probably tracks that question. I'm seeing a lot of energy efficiency type products and platforms that we have in our client suite that because there has been a reduction in the last decade of significant expenditure to energy infrastructure, that these platforms are doing well with customers and are relating to them. In the health space, I'm seeing medicinal products doing extremely well as well. So I'm looking at those type of platforms. There's some ed tech, so there's some disruption in the old sort of university sort of education system and platforms that I'm seeing taking off now. A lot of that's got to do with people wanting to do courses and so forth at their own time because of the post-pandemic. And I'm also seeing sort of cash flow products in the financial sector, because cash flow is quite important at the moment, that are doing really well too. So those are the type of industries and sort of indicating some of the qualities that we're looking for in the businesses.
And in case it wasn't clear, clients only, right?
That was actually going to be my next question. I was going to ask to tease that out from you.
Yeah. Interestingly, since we stuck our head up, we've had a couple of startups come to us. So, for you to invest in us, we need to become a client. It's like, no. You're not thinking about this the right way, right? They are clients that are, they're already our clients, right? Or they're going to be clients that, sure, sign up today, right? And we work with them for a couple of years, but we're going to get to know anyone before we throw them through the investment network, right? So not quite the right way. So just again, that is our fundamental promise. Someone said it to us the other day of, so basically you're doing our due diligence for us. Well, kind of, right? There's a presumption, again, right? We will not stray from this. They're going to be people that are known to us, both at a founder level and a financial level, right? Simple as that, right? So we will not put up anyone that, we're not comfortable with at that level. And Cheryl herself, obviously, as a syndicate leader in her own right, you're still coming at it from the outside, right? So you're doing your best due diligence, you're getting to know the founders, you're asking about the competitors and their finances and all that. Sure, right? But you're still not as inside as we are. Simple as that, right? So we won't stray from clients. We figure just because of the I guess the mutual capacity of ourselves and our syndicates, we'll probably do about 4 deals a year. Is kind of roughly what we're saying, right? But we might do 2 at one time and nothing for 6 months, right? It just depends on where people are at. It is definitely true that because we see those forward cash flows, we also see when people are going to be raising, right? So we're in continual conversation about that, right? So we've got an early look in, right? And depending on how much success we get within our own syndicate, we might be part of a round. Unlike if it's an early, the first money in, we might be able to fill it in our own right. If the clients already that we've been working with for years, so they've probably already had their angel rounds, right? But they might be looking for a VC or a larger investor round. They're raising a couple mil, and we've got the opportunity between us to do a couple of $100,000 in there. Awesome, right? Sure.
So it sounds like the stage, the companies that you'll be investing in, really, like, it could be really early stage, it could be a bit later. It's like agnostic across stages, and also looking at different businesses in terms of sectors and industry. But the unifying theme is that they'll be clients that you have worked with for a while and have an inside knowledge with them. Does that sound about right if I summed it up?
Yeah.
As I said, I'm keen to have a little bit of portfolio risk between us, right? So if we want to have a bet each way on some earlier stage ones, I'm still keen. We'll put it through a pipeline. We'll be really clear on it, right? When we put it up. So I'm keen to still get an early look in, right, on some of our earlier clients, just to have a bit of fun that way in an earlier spread. But I suspect most of them will be as part of a larger later round.
Yeah, sometimes it's good to get that first check-in just to secure pro rata rates for later on. Even you're like, well, if it doesn't go well, then cool. But if it does, then I get pro rata.
Exactly.
Yeah. Okay, so we talked about types of companies. We talked about what stages, how many per year, and why that number.
Yep. Why that number? 4 number, Mike?
Oh, I think we want to give sufficient time and consideration to every opportunity, and also think the process lasts a couple of weeks for each round, and we want to put them in batches, in quarterly batches. I think that's how we've looked at it, Remco.
Yeah, and it's also capital, right? Pure and simple. As we said before, we're us personally, right? Just to be really clear on that, because we are investing into our own business, including expanding to the UK. That's taking some of our personal capital, right? So we don't want to put a deal up that we're not putting some of our own money in, right? So we might have a conversation about that at some stage, Cheryl. But at this stage, we're going. Yeah, we think that's what's doable within our own remit.
And you're really close to the founders. I mean, Mike, you talked a little bit about this already in terms of what you look for in founders, but maybe you can expand a bit more on that. Like, because you talk to the founders, week on week, what are you really looking for?
Yeah, so the way our services work was we're speaking to them weekly. So we're speaking to the founders pretty much weekly, and sometimes every other day, because they've got other issues that they need us to speak with. So we're speaking to them about how they're getting how they're generating customers, what are the problems they're facing in terms of resourcing, what are what's the tech issues, what are their are they reliant on a couple of customers, are they how are they scaling with their tech and facing customers, what's the inventory issues that they're facing as well. And we're noticing from characteristics, I think if you're referring to the character traits, they're extremely focused, the ones that are doing well. If they've got a question, they're taking time out to speaking to us, so I'm respectful of their time. They're extremely driven, so they're working crazy hours, not just the usual hours. And they're always interested in expert advice from everything, that they know what they don't know. So they're very, very honest with themselves. These are founders that have done well. They will speak up and say, listen, I don't know what I'm doing in this particular area. This is what I require expertise from you. So they're very open and frank about their weaknesses and their strengths, which is a good character trait to know. So we're constantly in talks with them about what areas of expertise. Some of them are great software engineers and really don't know how to market themselves well. So they don't know how to generate lots and lots of leads to get customers, and they'll openly admit that. And others are really good at sales and strategically, but are not great at the operations at the software engineering level. So they'll ask, they'll readily admit that. So the ones that are trying to do everything, they're the ones that I get concerned about. But the ones that sort of are focused on their particular expertise and lean on other people, we kind of look for those kind of people who know their expertise and know what they don't know. So yes. So we consistently see our founders in the best and the worst light. So we're seeing what's going on day to day, the weeds, what's working, at their best and what's not. So, Remco.
One of the things I've always liked, and I think it's an attribute of success for founders, right? Is a founder driven, and so that drivenness for me is all about, do they know where they're going? Are they focused on that? Right? Okay, we're growing, we're new markets, we're hiring, focused, right? So that top level, but also someone that can, in their wheelhouse, whether it's marketing or tech or finance or whatever, that they can flip between the focus-driven top level, but also down at the detail level, particularly where it comes to their market and their customer base. Right. So we've got a couple of construction tech clients as an example, right? The founders of their construction tech SaaS company, right? They understand construction, so they can talk to the site supervisors that are building stuff. They understand the problem at that level of detail. So someone that, here's my startup, I'm growing, I'm focused, and in a moment's notice, I can get into the detail of my ideal customer, right? So I like that characteristic.
Awesome. I think, similar to a lot of things that I look for as well. Maybe along those veins, how would you describe your inside advantage around being intimately close on the financial performance side, and any rigor that you go through when working with the startups and investing in them?
Yeah. So as we are right day to day on their financials, we test their assumptions. So we're always pushing back on their blue sky type. If they are the founders that are extremely blue sky, we are always testing the rigor of their assumptions by different scenario analysis. So we're always, we don't pretend, we don't like hockey stick. Obviously, we see hockey stick numbers. We're gonna be pushing back seriously on that. We're generally, because we're sort of risk mitigators, we often are making sure that their numbers actually stack up to the customers and the clients that they actually can get. So we put a significant amount of rigor over that, and because we're seeing the day to day what the actual is, we do reforecasting pretty much every month if we don't see reality matching their future expectation, and reality always wins out of expectation. So we are often sometimes bringing our founders back to reality. We know that they're facing investors and shareholders and so forth, so we know that is an ongoing balance and ongoing sort of kind of dance that they have. They're trying to make sure that their investors are happy, and then trying to ensure that they stay afloat. So we're I mean, that's kind of the rigor that we have from day to day, and we're using all types of tools and metrics and so forth to make sure that their finances are in order.
Yeah, no, good segue. Thanks, Mike. It's almost like we practiced. I'm a bit of a SaaS geek, just for a bit of fun. Some of you heard of me talk about this. We're an S. Standard Ledger is an S, accounting as a service, just for a bit of fun, right? But yeah, lots of our clients are B2B SaaS. So I get off and geek on all of the SaaS metrics, the ones that you'll hear about, churn, CAC, LTV, etc., all the way through to which is all about growth and retention. Lots of FinOps, right? Operational. You talk about operational, right? Us personally, but also the whole back end team is really in there making sure that all that boring old accounting stuff like revenue recognition, etc., is done to feed into metrics that make sense. It's often a journey that we take our clients on, as Mike was saying, so that we can look at those metrics. Is it all trending in the right direction, right? Churn down, customer acquisition cost down, retention up over time. And eventually, as you get to the larger SaaS companies that we work with, actually making a profit, right? At that gross margin kind of level, the rule of 40, right? The trade-off between profit and growth, right? So I geek off on a lot of those metrics as well. So and the other reason I like them is they tend to be lead indicators. Again, most of your business people, you get the P&L and balance sheet. Regular accountants get that stuff too, right? They look backwards, but I geek off on the metrics that are a little bit of the early indicators, right? So if we've got customers, they're still paying their bill, but man, they haven't logged on for 3 months. It's like not going to the gym for 3 months, right? They're about to churn. All right, let's make sure they don't, right? So yeah, so we get into the weeds, and again, I love it because it's building business stuff.
Awesome. I love it when you geek out on those things. So I know that we're in good hands there. Let's talk a bit more about the syndicate. Are there any requirements to join your syndicate?
There are no requirements other than being a sophisticated investor to join the syndicate. So any one of our clients can join the syndicate as long as they meet that sort of compliance framework.
What about requirement to invest?
I am keen, and I think it jumps on, Ben, you asked a question, you're looking for any other particular experience. I'm keen to know, and we'll reach out separately, right? As well as bringing money, because that's kind of buying the seat at the table, if you like. Who's keen to kind of work with some of our clients, and what skills do you bring, right? Clearly, we bring the finance stuff, right? If anyone else has got finance stuff they want to bring to the table, awesome. Let's know about it. But what's your particular thing, right? That you'd like to bring, or you'd like to see more of, right? Because we'd love to hook you guys in. Obviously, bring the money, but bring your skills.
Yep, great answer. I was going to ask that one as well. So it's good to know that if there are investors who want to support some of the portfolio companies, that they can jump in and you'll get a good understanding of everyone's skills. We might jump over to a slightly different thread. We have a question from Daniel. He says, I've heard a lot about traditional venture capital and the power law concept, which is investing across a number of opportunities with the expectation that most of them are going to fail, and one out of however many is going to 100x. Canva, the 3000x one. Hopefully you hit that, but normally you have to invest in a lot of companies in order to get that. So do you think there's a similar dynamic that's applicable to the syndicate, or do you think it's more of a case of extremely vetted opportunities delivering more predictable, but maybe less ambitious outcomes over time?
You want to answer that, Remco?
Sure. I was going to say, so at a portfolio level, right? And Cheryl also, you've got a wider network of up to 1,000 angels across all the syndicates, right? So happy to jam on that. But the way that I look at it, right, and it goes all the way back to, I think, Markowitz theory, right? I'm an ex applied maths dude as well. And I was looking at portfolio concept broadly, right? So you hear the VC stuff, 1 out of 10, kick it out of the park. I like, and I've always liked, a spread, right? So, I personally, by setting up this syndicate, I'm looking for the spread of between 20 and 25 investments that de-risks it sufficiently, right? So that amongst that, hopefully we get a Canva or something in what we're trying to work towards. But de-risks it, you're trying to find that trade-off between the returns and the risk. So if you're an angel investor and you're dipping your toe in your water and you put your money in and it's failed, right? You've had 100% failure rate, right? The trick is not to take your bat and ball and go home at that stage, right? So everyone that's looking to join us, right, and investing in your own right, for me, definitely it's a portfolio game. Cheryl, do you based on what you see elsewhere?
Yeah, I mean, I think in general, like syndicate investing actually makes it easier to deliver or to set up a portfolio across a number of companies, because if you're going to invest in just one or two companies that you vet yourself, then you're looking at like $50,000, $100,000 checks, sometimes less at the pre-seed. But with syndicates, you can say take that amount and divide it by 5 or 10 and get the same amount of or get more spread in terms of portfolio with the same amount of money. So, I mean, personally, I've found that syndicates have been a great way to actually diversify and get that larger portfolio with less funds to start out with. But I think in terms of like the vetting of ththings, when I first started angel investing, one of the things that I was told was in the early days when you don't have access because you either don't know who to approach or you're not well known enough for the good founders to take your money, then try to follow people that you trust. And so again, that's how I leveraged syndicates, was calling up some of the people that were running them and being like, hey, can I put my check in alongside yours? And so that's partly why we're doing what we're doing with Aussie Angels, to enable other people to get access to the deal flow that you guys have. So yeah, I'm a big proponent of the portfolio, the large portfolio approach to investing, but it's certainly not the only approach that you can do to investing out there. So not business advice, not financial advice. I will give the disclaimer on behalf of all three of us. None of this is financial advice. Actually, I probably should have done that at the start. None of this is financial advice, everyone. Let's jump to another question here, because we do have quite a few that are coming through.
But what it's useful just to segue off that is not financial advice. So there's no lock-ins on any of this, right? So the way the process works is, clients that we think are interesting, right? We'll go through the rigor, right? Obviously, we know them from the inside, but we'll go through the rigor of going, here's why we think this is useful, not just because we like the founders. So the degree of rigor, we'll put that out there for anyone that wants to come along for the ride, right? We'll tell you what we're putting in, right, as well. So I'm picking up a few threads and questions at the same time, Cheryl. So minimum check size, right? We'll look at it deal by deal, but I typically go, it's depending on if you want to be bullish on any particular deal we're putting up, go for it. But I'm typically saying 10 to 100,000, somewhere in that broad range, right? You might decide, hey, this is the one. This is the next Canva. I want to put 100 grand of my own money in there. Awesome, or plus. I don't know that there's necessarily an upside to it. Sorry, a top side to it. But probably not worth any of us kind of getting even a little bit interested below 10K a pop. So
yes, I think that, just to be clear, like the syndicate is, if you join, you're just putting your hand up to say, I'm interested in what Mike and Remco are investing in. And then when they're investing in something, they'll put it to you and say, we're investing in this, here's why. And you can decide on a deal by deal basis. So you could join and just, not like any of the 4 deals that they put up that year. And that's cool. You just read the deal notes. You're like, nah, that one's not for me. So it's very much deal by deal. There's no commitment to invest required. And there is no membership fee, so there's no cost to join the syndicate, but we do take a percentage of the amount you invest if you do decide to invest, and that covers the legals and everything to set up the entity and manage it for the entire lifetime of the deal. And all of those fees will be clear on the deal note for you, as well as Alex, to answer your question, yes, on the deal note, along with listing the fees and other things that you need to know, there will be a section on use of funds. So you'll get a sense of what the startup's planning on using the funds for. there's a lot of sections in the deal note that have information like that. For example, it'll also have a section around due diligence, around what due diligence did the two of these guys do before they decided to invest in this company. So, and you can, yes, Peter, you can also invest via your self-managed super fund. So you can invest in the deal via just as an individual. You can invest via family trust or a discretionary trust. You can invest via a company, and you can also invest via your self-managed super fund. So we pretty much accept any investment entity that you want to invest through. You just have to go through the verification process.
And again, Cheryl, that can be done on a deal-by-deal basis, right? So
it's correct.
Yeah, subject to the original sophisticated investor check. If you're trying to spread internally in your own asset management, that hey, this is one you're going to take personally versus a family trust versus a specific investment vehicle that you might have, all good.
Yeah, we have some investors that actually do. Like they'll split it. So one of our investors, every time he invests, he does 10K in his like individually, and then 10K in his super as well. So yeah, you can actually do both on one deal if you want.
Yeah, I am seeing our clients using their self-managed super fund to make investments, or to even for their own business, making investments into strategic startups. So yeah, hope that answers your question, Pete.
And on funds, Cheryl can attest, and Vince as well. We're finance people, right? So we asked all the finance questions, right, about how that works, right? So on our own Standard Ledger Ventures website, which we'll send you a link on afterwards, right? It's got a couple of those initial questions about carry, and there's a $60 fee that Aussie Angels charges to kind of do the ID checks and stuff like that on the first deal, right? That you do through Aussie Angels, not the first deal with us. Right? So if you're already in another syndicate, already done, tick. So other than that, $60 upfront, and then there's a 6% that Aussie Angels does to set up the deal for all of our sakes, right? So 6% of our investment money goes out, right, as well. And after that, it's all carry, right? Because let's face it, the reason we're trying to do this is the upside, right? And so go from there. So yeah, I'll definitely happy to talk more how we harangued just to make it clear, right? So 6%, is it 5%? No, what is it, right? So it's all up on our Standard Ledger part of it. Plus also hit up Cheryl or me or Mike anytime.
Yeah, exactly. If you have any questions, we've got FAQs all over the place. And also, if you join, you can always reach out to any of us.
Yeah, so that what Remco mentioned is we're reinforcing, we're very transparent about all the costs associated before you actually make the investment. So it'll all be clear before you make that investment.
Cool. Any other questions? If you have any questions.
Mike, Alex had a question on, you want to have a chat about that? Use of funds? Regarding guidelines of how the money will be used. The investment money. Yeah.
So we're going to have the methodology that we're using and the committee. Yeah. So we're going to put in place a review and a committee to actually go through that process, whether it's looking at ensuring that their legals are in place, financials, obviously, IP, etc., agreements, everything will be in place. We'll have a due diligence format for every deal. We'll go through that rigorous check.
Broadly, and the reason we're backing these startups is growth, Alex, right? It's certainly not to go pay off founder loans. We just by the by, we always encourage, and obviously we're in there as accountants and even bookkeepers. We encourage founders to kind of put on the books the founder loans, right? So that this is real hard cash, but we also always tell them expect that to be asked to go away as soon as investors come in. Yeah, nice to know you backed your own startup for 100 grand, but it doesn't really matter. You've got your own equity. Make it go away. As accountants, we make it go away, right? Or at the bigger end of town, sometimes there's loan agreements, etc. But most of the time it goes away. And so yes, funding broadly, Alex, for growth. That's what we're all backing.
And each deal will have a summary of how the startup plans to use those funds as well. So if you join the syndicate, and then you can actually read the deal note that shows like what they're going to be using the money for. So that's always listed. We make sure that they list that. Cool. And I guess last question, do you have any exciting deals coming up soon you want to give us a little teaser on?
As I alluded to, there is a couple of in our portfolio of clients. There's a couple of deals that, or I'll make it sectors that we're kind of looking at. There are sort of health sectors that we're kind of looking at that look nice. There's as medicinal herbs is one, medicinal products. There's an ed tech.
Just call it what it is. Just call it what it is, Mike. Cannabis.
Cannabis. Well, yeah, it's obviously very popular in Australia. I'm seeing ed tech platforms that are disrupting the sector that's doing extremely well. I'm seeing energy efficient platforms, as I sort of alluded to before. They're doing very well. A lot of consumers are looking for the best product to save from their energy efficiency usage. So I'm seeing some products there. Those are kind of the sectors. And the other one I alluded to was fintechs that are providing cash flow to their consumers. So cash flow is king when it comes to financing. So I'm seeing in that space deals businesses doing really well in that space too.
Be the bank.
Be the bank.
Be the bank. I love it.
I personally like as you know, I've been hanging around with AgTechs for quite a number of years as a mentor with SproutX and the like, and I like the premise of next generation kids, right? So the parents and the grandparents have been on the farm, and the kids are coming to the city, trying to bring the tech back to the farm. I like it, and I haven't put any money into the space. I like it as a premise, but geez, hardware is just hard. Right, for the ones that are hardware related, so it's unlikely, right? But you know, I'm curious about it nevertheless. I personally keep an eye on it, and if it wasn't clear, I don't do crypto.
You're hardware curious. I like it.
Yeah.
Awesome. Well, we're coming to the end here, so if anyone has any other burning questions, this is the time to either raise your hand or pop them in the chat. Otherwise, we might give you 5 minutes back. We were saying, if we end early, we'll give everyone a bit of time back, but it was a great chat, and I really appreciate you guys taking the time to answer all of the questions here today. Yeah, I think I've even learned some things, and hopefully all of you have as well. We've got the link to their syndicate profile on the chat there. You'll also get it in your email. You'll also get a copy of this recording. So if you're wondering, what did they say? I want to go back, then you'll get that in your email as well shortly. So yeah. Thanks, everyone. Really appreciate your time today, guys.
Great. And as always, call to action, right? Every good talk is a call to action. So join us if you haven't already. If you have already, thank you. And hopefully a bit more information. So we'll probably bring our first deal through in the next month. So also always good to have a time-sensitive call to action, right? I'd love to have you guys along for the ride.
Thank you.
Awesome.
Cheers.
Thanks, everyone. Yeah.
Bye.